Hi there, I'm Matthew Lester from the Rhodes Business School. Now, a lot of Rhodes alumni will tell you that the definition of a Rhodes student is somebody who's not frightened of a tequila bottle. And this is quite important if one looks at an upcoming date, 22 February, it's National Tequila Day. And what we're going to do is say, well, what else is important on that day? Well, for those of you involved in finance, and in fact all other South Africans, we're looking at the date of the National Budget speech. And this year, Prof Gordon is going to have a rough time of it. The economy is not performing. He doesn't have any new taxes in the pipeline. Basically, it's looking grim, particularly for the higher-end taxpayer. So, we've got to make the most of it. And we've got to adapt, overcome, and survive. And we've got to say, could we score a tax deduction in the 2016 tax year, that's the one that ends on 28 February 2017, that is even bigger than the tax increases that Prof has got to install for us in 2018. I think you can, but people go about it the wrong way. So we have to get all of this achieved before the 28th of February 2017, when the 2017 year of assessment comes to a close. Let's play with it. So some say you can achieve a tax deduction by reducing your income. Well, that's very difficult to do if you're employed. Basically, your employer is not going to tolerate it. Others say, let's claim expenses, like let's go out and buy a new car. It's going to make very little difference. Some try and claim a home office expense. They can't claim it because they've got an office at work. Some even go farming. Or the alternative is to reach for the bottle, debit experience, or credit bank, or vice versa, whichever way you want to look at it. Maybe not. We're better than that. We can still find tax deductions. The way we look for it is by going into retirement funds. And for many years, we had a formula called NRFI. Now, this was a formula actually designed to fail tax students. Whoever wrote it must have had a tormented mind. And it put a severe limit on retirement annuity fund contributions of employees, simply because they already had a pension fund. So the architect was looking to confine retirement annuities just to those who carry on their own trade. Now, fortunately, that has been euthanized now, and with effect from 1 March 2016, we get a new formula for determining overall retirement fund contributions based on 27.5% of taxable income and capped at 350,000 Rand a year. Now, when this all came out, there was quite an outcry from the wealthy. They used to make multi-million Rand contributions based on non-retirement funding income, being interest and share options and the like. So that's what the press looked at. They didn't look at the lower-end taxpayer. Taxpayers between 250,000 and 1.2 million Rand a year actually scored enormously out of this new amendment. It works like this. So let's take a bloke who's earning R1 million a year. Today, his allowable retirement fund contributions at 27.5% are 275,000 Rand a year. But what you will find is that the provident fund for the firm for which he works is probably only deducting 15 or maximum 20% of the 1 million Rand. So let's say he's only made contributions of 150,000. That allows him, if he's clever, before the 28th of February, to make an additional retirement fund contribution of 125,000 Rand. So you run through that formula, and what we get to is a massive additional retirement annuity fund contribution, which can be claimed in the 2017 tax year. So, if they're clever, by July or August, hopefully they get a refund of 51,250 Rand. Now that's an enormous tax break. A Rhodes student would say, that will buy you 400 bottles of tequila. Well, maybe not. What's brilliant about that is we can take that tax refund and actually throw it into the 2018 tax year and create another tax deduction. That's what the tax profession call a double dip. It's the absolute prize in tax. Now we take all of this and people immediately say, is it legal? Is SARS going to attack me? No, SARS hasn't got a leg to stand on this. They can stand on their head and sing Mshini Wa. Bottom line is, it's a provision within the Tax Act that is a stimulus for you to make these contributions. SARS aren't going to attack you for that. They're just going to ask you for a certificate. Then comes the question, is this a good idea? And so we go and have a look at what's going on with retirement funds today. So what we've looked at so far is that retirement funds give you quite a big contribution, 27.5% of taxable income, at a 41% discount achieved through the maximum marginal tax rate. That's wonderful. But then the beauty continues, because what we get is that all returns of retirement from retirement funds are exempt from income. And there are further bells and whistles which can be built into a financial plan built on retirement funds, including that on death, it's going to be both CGT and estate duty exempt. What we see today is that the retirement fund has essentially replaced the trust in efficient estate duty planning. So then people say, yeah, I'd love to do it, but I haven't got the cash. I just don't have 150,000 Rand lying around at the moment. We've just had the holidays, back to school, Valentine's Day is coming up, and a tax payment at the end of February. For many, that's too much. But what you look at with this is we say, what about geared investment in retirement annuity funds? Now this one, you've got to think quite widely. Let's look at it this way. There are your interest rates and inflation rates in South Africa over the last 25 years. And if we go back to when Chris Stelz was head of the Reserve Bank, he said, I want an interest rate at 10% above the inflation rate. Then it was a no-brainer to put money in a savings account or to buy a property and make accelerated bond payments. You were achieving a return of some 20% per annum. But Chris Stelz is long time in retirement. He was succeeded by Tito Mboweni, and interest rates were brought back to the inflation rate, and the successors have kept it there ever since. So whereas on the access bond principle 20 years ago, you were scoring a risk-free return of 20%, that was unbeatable. But when one's looking at the return on an access bond today, we're saying it's not a tax-deductible investment, and you are only receiving a return of 7 or 8%. So use the access bond to raise capital that will give you a tax deduction. So you draw money out of the access bond and you put it into the retirement annuity fund. Now, in old terms, old investment thinking, that was mad. But today things have changed and it makes good sense. If there's a tax deduction, you've got to go after it. So in conclusion, what we're saying is, yes, we have 22 February as Tequila Day. Right, tax and tequila work well together. We are looking for a slam dunk, foolproof tax deduction. The only place you're going to get that guaranteed is through a contribution to a retirement annuity fund. So what you should be doing is phoning up your financial advisor and saying, I want you to look at my tax comp for 2017 and tell me how much I can contribute. He should have done that already if he was doing his job properly. If he hasn't done it, you can show him this video and you say, hey, you owe Matthew Lester a bottle of tequila. Thank you for your attention.